Hello. In this video, we'll be going through attribution and post-retirement benefit obligations. So, what are post-retirement benefits? These are benefits that an employer may offer to their employees upon retirement, which are not a pension. So think of medical coverage that once you retire, the employee retires, they get medical coverage. They might get life insurance after they retire and when they die, group legal services, dental coverage, and all sorts of other benefits. So anything that's not a pension, but the employer provides these benefits to their employees upon retirement are determined to be post-retirement benefits. There's two obligation amounts related to the post-retirement benefits. And when we say obligation, we mean liabilities, right? Just like when we have a pension, we have a projected benefit obligation that the company records for the future payouts for those pension payments. Similarly, when a company needs to accrue a liability related to the potential benefits related to the healthcare and dental and whatever it is that they offer, the post-retirement benefits that they're going to end up paying out to their retirees, they need to accrue that as a liability. Now, and those are called post-retirement benefit obligation. And there's two post-retirement benefit obligations you need to know. The first one is the expected post-retirement benefit obligation. And this is just like a pension uses an actuary to determine what the projected benefit obligation is. There's also actuaries use it to estimate the total benefits that a corporation can expect to pay out for the plan participants, for the employees that have retired. And then we discount that to present value. Now, it's also referred to as the EPBO. So the EPBO is actually the total, this is really key, it's the total benefits that the company expects to pay out in the future. Then there's another concept called accumulated post-retirement benefit obligation, which is a portion of the expected post-retirement benefit obligation, the EPBO, and that's only attributed to employee service to date, and this is the APBO is what actually gets recorded on the balance sheet as a liability. And we're going to go through these to show you what the difference is between what the two are. So just as a visual, let's talk about pensions first. When we're talking about the projected benefit obligation for pensions, right? We have as employees continue to work for an employer, this is obviously for an employer that offers a pension plan, right? So as they continue the number of years that they work, then they get more and more money that they will get paid out in their pension upon retirement, right? So the more service years you work for that company, the higher your pension benefits will be upon retirement. One of the big differences in post-retirement benefits, so let's think about this in terms of healthcare, right? When a person works, doesn't matter how many years they've worked, the healthcare that they will need upon retirement is not going to necessarily increase, right? Because whether you've worked 30 or 32 years at a company, that's not going to increase the healthcare retirement benefits that the company will have to pay out for you, right? Versus a pension is a set amount each month or each year that the retiree gets. This is an as needed basis, the post-retirement, especially when you're thinking about healthcare. And the way the post-retirement benefits work is it doesn't matter how long you've worked at that company for, assuming you've worked long enough to be eligible for those post-benefit retirements. It's an all or nothing kind of deal. So if this company says, oh, you need to work 15 years at our company in order to receive these post-retirement benefits, and so it doesn't matter if I work there for 5 years then I get $0 upon retirement. If I work there for 10 years, I still get $0. It's not until I work there for 15 years that I will be eligible for these benefits, right? Or I like to call it until I invest in these benefits. So what we do is we calculate what the total amount of these post retirement benefits are, and we present value them to the current day. And then we take a fraction of that total based on the number of years that employees have worked, because now they're 1 year closer to vesting. So I like to think of it as 1 year closer to actually having to pay out that post-retirement benefit. And so we take a fraction, right? It's a fraction, it's a percent, and that's what we record as our liability. The way we record, I said there's a fraction, right? The process of assigning the cost of benefits to the years during which those benefits are assumed to be earned by employees is called attribution. Okay, this is how we assign a portion of that EPBO that I was talking about here. This EPBO that we take a fraction, this fraction is part of attribution. So, or the attribution concept, I'll say. And the way we calculate basically that percent, it's a fraction, is we're going to take, and you assign an equal fraction of the EPBO, which are the total benefits we expect to pay, to each year of service from the employee's date of hire to the full eligibility date. Okay, so from the date of hire, I'm going to say date of hire here, through the eligibility date, I'm not going to spell the whole thing out. This time frame is called the attribution time frame, the date of hire to the eligibility date. And we're going to take the EPBO and assign an even amount to it every single year, right? When it takes, if this is a 20-year period, then we're going to take the EPBO and assign 1/20th of it and accrue it in our balance sheet every year. Let's go through this example of determining the attribution period. Okay. Callie Farrow was hired by Global Communications at age 22 at the beginning of 2016. So I'm going to go right here, 22. This is right here, 22 in 2016, and is expected to retire at the end of 2055 at age 62. So right here, I'm going to write my timeline. Age 62 is the retirement date, and 2016 was the hire date. Global employees are eligible for post-retirement healthcare benefits after they both reaching age 56 while in service and having worked 20 years. So this company says, in order to be eligible for your retirement, you have to do two things. You have to be working at the age of 56 at this company, and you have to have worked for 20 years. So she got hired at 22. Age 56 is her eligibility date, right? Which ends up being 2050. And then you say, okay, is this at least 20 years? Because she needed to be 56 and having 20 years of working at this company, which from 2016 to 2050 is 35 years. So she definitely met that 20-year service marker. So when we're talking about the attribution period, our attribution period for this employee is 35 years. It's from the date of hire through the eligibility date, which for her was 2050, which is the year she would turn 56. Let's do a concept check. Pierce Products, Inc. sponsors a post-retirement plan providing healthcare benefits to employees who have completed at least 10 years of service and are age 53. So we're looking for two things for their eligibility: 10 years of service, and they have to be 53 years old at retirement or older. To date, The employees that have retired under the plan have an average age of 60. Okay, this is irrelevant to determining the attribution period, which is what we're going to be asked for, right? And it tells us no employee has worked beyond age 65. Again, irrelevant for determining the attribution period. Okay, so we're going to, okay. Taronda was hired when she was 46 years old. Okay, so let's draw the attribution period we need. The attribution period is going to be our hire date. Okay, hire date. And till the full eligibility, till the eligibility date. Eligibility, I don't know if I spelled that right. So we're told that she was hired at 46 years old. The attribution period for accruing Pierce's expected post-retirement healthcare benefit obligation to Taronda is during the period when Taronda is what? So let's figure out what is this attribution period. Her hire date is 46, and the eligibility date we have to figure out. We have to figure that out. Well, it says that in order to be eligible, employees have to be 53 years old. So here, she'll be 53. Let's put 53 here, right? But you also had to have worked 10 years. So from 46 to 53, that's only 7 years. So that's not going to work. So even though she turns 53, she's still not eligible for those retirement benefits because she needs a full 10 years. So she has to work until she's 56 because she got hired 46, and she needs to work till 56 in order to be eligible for these benefits. So when the question asks, what is the attribution period? Her attribution period is from 46-year-olds to 56 years old. Okay. I want to go through. I'm not going to go through an example, but if you're familiar with the pension accounting, the post-retirement benefit accounting is similar in terms of how we account for items. We have a post-retirement benefit expense. So think of this as similar to the pension expense. And when we have that expense, when we have service costs, we debit that expense. We can have, if we have planned assets for the post-benefit retirements, which oftentimes employers do not have for this item, but if we do, and usually we expect the assets to go up, so we would actually be crediting the expense, but it is possible to be debiting the expense. And then we have OCI, or amortization of OCI for prior service costs. If we just implemented a post-retirement benefit plan and need to accrue liability for past years' service worked, or if we have an amendment to an existing post-retirement benefit plan, or if we have amortization of net loss of an OCI or a net gain of OCI due to the expected plan asset return versus actual plan asset return. There's all kinds of things. I'm not going to go into it, but we will, so the accounting for it is similar. It's just you're basing it on the accumulated post-retirement benefit obligation instead of the projected benefit obligation as you would with pensions. And again, if you have a plan asset for these post-retirement benefits, and you fund it, you would debit the plan asset and you credit cash. And again, we have all kinds of entries to OCI and the liability when we have a change in assumption, or if our actual is different, our actual return on assets, on plan assets is different than our expected. If this is not familiar to you, please go back. There's several videos that cover all these different concepts that we obviously cannot go through in a matter of 2 slides. But if they're not familiar to you, please go and review those videos. But I just want to highlight that the accounting for it is very similar. It's just the name of the accounts might be different. Okay, let's go through an example of determining our post-retirement benefit obligation. Assume the actuary has estimated the net cost of retiree benefits in each year of Cali Farrow's 20-year expected retirement period to be the amounts shown in the calculation below, which we'll get to in the next several slides. Farrow is fully eligible for benefits at the end of 2050 and is expected to retire at the end of 2055. Calculate the APBO, the accumulated post-retirement benefit obligation, and the post-retirement benefit expense. So think of this as more like the service cost attributable to the APBO at the end of 2027, 12 years after being hired. Okay, so there's several steps we have to take in order to be able to calculate those things. And step one is we have to calculate first the EPBO, and then we can take a fraction of that amount to calculate the APBO. But first we have to do the EPBO at the end of 2027, and it's a three-step process. I'm not going to read these, we're just going to go through the numbers. Okay, so step one to figure out your EPBO is we were told that the retirement period is 20 years, starting in, she retired at the end of 2055. So we're going to say 2056 is our first year. Okay. And what the actuary does is they're going to say, okay, we think when this person is 62, right, based on all the numbers of figures that we were given here, right, starting age and all that. When this person is 62, the company expects that they will have to pay out $5,000 for these, let's call them healthcare costs, okay? And then the next year, when they're 63, the cost might be $5,600, and the next year 63, and so on and so forth for 20 years. So that's the cost, right? So the difference between this and the pension is that the pension, for the 20 years that they're in retirement, the annual cost is the same. This is different, which means because the costs are different every year, and we have to present value that back to 2055, the date of retirement. We have to do a present value calculation per year, and we're going to do the present value of $1, right, for $5,000. And this is, we're going from 20 here, we're going to go from, here's my timeline. Let's say this is 2055 and this is 2075, because they're going to be retired for 20 years, right? So pretend this is 20 little things. So in 2056, right here, we have to present value this $5,000 back to 2055. So I'm going to use the present value of $1, n equals 1, and we were told that the interest equals 6%. When I look at 2057, right, so now here I am at 2057, now I have to present value back 2 years. So I look at the present value of $1 table, and here n equals 2, the interest rate is the same. And so on and so forth. So you keep having to present value different amounts back to 2055. So for each year, my number of periods is going to increase until I get to n equals 20 for 2075. Okay, so that's what this calculation is right here. And so when I add up all those present value amounts, I get to $62,269. So let me show you what we're going to do with that. So right now, what we've done is we've present value all these different costs that we're going to have for 20 years, and we've present value that to 2055, and that present value is $62,269. Okay, we're not done. Now we're trying to figure out the EPBO and the APBO for the end of 2027. So I have to take the $62,000 and present value it back to 2027, which is 28 years back. Okay, so what I'm going to do is I'm going to take that $62,269, look at my present value of $1 table, and using n equals 28, I equals 6%, and I get $12,182. So when I look at here, my EP, and that is my expected post-retirement benefit obligation. So right here, I have 12,182. This is what I expect my total benefit cost to be, when I present value to the end of 2027. This is not what I record on the balance sheet. On the balance sheet, I need to record a fraction of that based on the number of years of service that this employee has already worked, divided by their total attribution period. We've determined that the attribution period is 35 years because that is from the date of hire to the eligibility date, which we were told is they got hired in 2016, and the eligibility date was we were told that the eligibility was the end of 2050. That's how we got that number. So the attribution period is 35 years. She's worked 12 of those 35. So we're going to take our EPBO of 12,182, multiply it by 12, divide by 35, and that's how I get my accumulated post-retirement benefit obligation. This is the amount that I'm going to put on my balance sheet as a liability. The last thing that this problem asks is to calculate the annual service cost for 2027. And similar to how we do for pensions, annual service costs, we're going to do the same thing here. And the service cost, each year we have a service cost, and we're going to take the EPBO, that 12,182, and multiply it. We're going to look at the attribution period of 35 years, and we're going to divide that attribution period into 35, and each year 1/35 of that is going to be the service cost. And so we would debit post-retirement benefit expense, just like with pensions it would be a pension expense, and credit the liability. And in this situation that equals $348. This slide, I'm not going to go through it in detail, but you can pause or take a picture. But just so you know, relating to post-benefit retirement obligations or plans, there are a lot of different disclosure requirements for the financial statements and the notes, and they're all listed here. You do not need to memorize them or anything, but just so you know, you can see that there's a lot going on, and a lot of disclosure requirements exist.